Yeah, so this brings up another great point. On our website, we have a bunch of tools, and this isn't one of the tools I like to use a lot. It's the global inflation swaps, and I love to look at the twos and tens spread of inflation swaps. So a lot of people are familiar with the twos and tens interest rate spread, which is the difference between the 2-year yield and the 10-year yield. This is the difference between the 2-year inflation swap and the 10-year inflation swap. So if this value is negative, it implies that the 10-year inflation swap is less than the 2-year inflation swap. So you're doing 10 minus 2, right? That's how the spread's typically done. So if the 2-year is greater than the 10-year, it's going to be negative. And typically when the spread's negative, when the 2-year is at a greater value than the 10-year, it implies that there's a lot of short-term inflation or inflationary resistance in the market. The market's picking up a lot of inflation pressures in the shorter term, and it's alleviating over the longer term. So it's picking up some sort of hiccup in inflation, and this can mostly be attributed to tariffs. I think what this is basically telling you is there's a lot of uncertainty in the market regarding inflation. Therefore, for us to think the Fed is going to get super dovish here is probably a mistake, right? Like, to answer your question, yeah, like the Fed could easily push cuts off or delay or, space cuts out, and we could see the floor somewhat lift, but not due to rate hikes, just all it takes is 2 to 3 cuts to be removed from the cycle and you've pushed the floor up, right?